Do this.
I have a question.
Sure.
This might be stupid.
No, no
but,
problem.
What is the dividend? Is it what they're getting back from the stock?
Well, here's what it is the dividend, I think this would be the best way to show it here. What it is dividend, in this case, in most cases, right? A dividend is to a corporation, and by the way, I'm so glad you asked, Mariah, because I've never seen it where one person has a question. And somebody, we don't know who it is, is saying the same thing. Okay, seriously. I'm sure, somebody. All right.
Thank you.
They're not admitting it.
Thank you.
Thank you.
You're welcome. I thought it was going to be
No,
a
Mariah, you
stupid
just look so
question.
you just look so sheepish. I just wanted to assure you that somebody's saying that. Okay, that's all. I just was that shit. Okay, here's the deal. In this case, in most cases, what we're talking about is just distributing the net income. Okay, so revenue and expenses are close to retained earnings of a corporation, right? And then dividends come out of retained earnings. So in most cases, what they're doing is they're passing the net income from the corporation to the owners.
Of the stocks.
Okay, dividends to stockholders.
Okay. Wow. You don't have income summary anymore?
Huh. Well, you can. You could post income summary if you wanted to. Now, what an income summary, you could if you wanted to. Here's why you would use it, is the income summary, the purpose of the income summary is to keep detail out of, when we had the sole proprietorship, out of its sole proprietorship, so the capital account was easy to understand. You didn't have too much detail in there, because, like if you 100 expense accounts, and they're all closed. So you can, if you want. But again, all it does is it determines the net income and net loss, right? And its purpose is to keep those details out of the retained earnings or the capital account. So you could. Okay. I'll be right back. I think Jonathan was saying.
So dividend is like the company saying thank you for like believing in us, and so we're gonna give you something back.
Not quite. I think a closer answer is a dividend is to a corporation as a withdrawal is to a sole proprietorship.
Oh,
But the people that buy the stocks, they don't get to decide how much the dividend
Board of directors.
But they elect the board of
So
directors.
they-
And
So
they
in a
elect the
sense-
board of directors, yeah.
So in a sense, they do.
the stockholders.
is. And when you buy a stock and like why do you have the stock and the dividend go up on
Well,
that stock?
here's the deal. As a general rule, in order to declare dividends, two things have to happen. As a general rule, there has to be a net income and there has to be the cash. Both of these have to exist for the board of directors to declare a dividend. In other words, if for some reason they spend all their cash on an asset and they got no cash, even though they were profitable, generally they don't give a dividend, okay? And if they don't have a net income, generally they don't issue one either. Now, they can, if they issue a dividend when there's no net income, then they're returning some of the contributed capital. And that can happen, okay? For instance, what some corporations do is the fact that they're saying that what we're going to do is we're going to issue dividend, this certain dividend, every single year. And when we do that, then people who are like retirees, who want to live on this cash flow, they'll buy our stock and it'll keep the price up. So if they have a bad year with no net income, they'll still issue a dividend. It'll be the return of contributed capital. And that's why that's done. Does that make sense, Jonathan? Yeah. So, and that is done. There was, who else was in the queue? Was somebody up here? Julia?
Sort of answered my question, but so if you own 25% of stock, does it mean you get a portion of the amount of dividend?
You'll get 25% of the dividend.
Okay.
So it will, if you own 25% of the stock, you'll get 25% of the dividend. That is true.
But the dividend is not necessarily the whole net income, it depends on the situation.
As a general rule, this is what has to happen for the board to consider issuing a dividend. They have to have a net income and they have to have cash. They still can issue a dividend, it's their discretion, but if there's no net income, then what they're doing is they're returning part of the initial investment to the capital. Yeah.
Are dividends only dispersed after the books are closed?
No, they can do it anytime.
Any time of the year, they
Any time of the
more
year.
than once?
Yeah. And again, it's the discretion of the board. Let me give you an example. For instance, it was Microsoft. What they did is they were extremely profitable, and they had a ton of cash, and they issued no dividends for decades. The first dividend they issued was, within less than 5 years ago. You know, time flies, a little bit dead, but it was something like that, right? And their stockholders were up in arms. They said, we have an incredibly profitable company, you got a ton of cash, we own this business, we want some return on our investment, right? The board of directors up to that point had previously said, no, in our line of work, it's governed by breakthroughs. When a breakthrough happens, we need to move, we need to do quickly, and they're never cheap. We need a ton of cash. And if we don't have a ton of cash, this business is in peril. You don't get a dividend. Finally, they accumulated so much cash, then they were able to issue a dividend. But they had to maintain so much liquidity that even though they were very profitable, they didn't issue a dividend, and their stockholders were complaining. Because we own this damn company, and you're not giving us any of this property, and they got a ton of cash, and you've been really profitable for a lot of years.
I think that's what's going on with Apple right now.
Should be, but I mean, that's an example of how that works.
I'm not on the inside board, I
Okay,
feel, just so you know.
sounds good, okay. All right, any other questions or comments?
So those who sold their stocks before the dividends were issued just lost their.
Sure, exactly, so I'm gonna turn this around. So again, what happens on this thing, I should have turned this around earlier, but it'll still work, because I think this is pretty much a discussion. Sure, the way this works now is the fact that whoever owns it on whatever this date is, and let's just give it a date. Whoever owns it on, I'm just making this date up, whoever owns it on January 19th gets the dividend. Okay, so if you bought it January 18th, it's yours. If you sold it January 20th, it's yours. If you bought it January 30th, it's not yours. So whoever owns it on this specific day gets it. And the registrar is the person who will know that. Eddie?
So it's not prorated?
No. Whoever owns it this day gets it. Now, these are public facts, right? So there's no sneaky here. That you know, this is published like Wall Street Journal or whatever, so you know that when you buy it, you pay more for it on this day because it'll include a dividend. This day you pay less because there's no dividend. All right, you guys doing good? Okay, accounting for cash dividends. All right, common stocks payable. All right, let's do this. Let's do a quick study. 13-7, and you find that on page 536. Okay. All right, let me put this on the board for our viewers at home. Turn out a light. And then it'll be about time for a review. We'll see you next week. All right, so it's quick study 13-2. Oh, it's right up here at the top. Oh, oops, no. Quick study 13-7, right down here. All right, so prepare the journal entries to record the following transactions for the Emerson Corporation. I'll put this here and make this bigger. Okay. So on April 15th, April 15th, they declared a cash dividend payable to common stockholders of $40,000. That's the amount of the dividend. May 15th is the date of the record, okay, for which for the cash, so it's the date of record, whoever owns it, May 15th gets it, and on May 31st they paid it.
ever, because they always refer to the dividends as cash dividends, can they do dividends as more stocks?
Yeah, and we'll get into that. So, and what happens to that thing is you can have a stock, so sure. And so I'll put this up here when you guys are ready for it. Sure, they are stock dividends, we'll get into that,
Okay.
probably get into it Monday. We will get into it Monday.
I have a
It's-
question.
Yeah.
Does the dividend get paid like into the stock, or is it like cash you get?
Well, what we're talking about here is a cash dividend. So in this case, it is cash.
Okay,
Now, there is a stock dividend.
where it builds the value of the stock.
Yeah, kind of what happens here, we'll get into that in a minute. We're talking, but let's just for now get this done, we're talking about a cash dividend. And in fact, we'll have a minute, so let me do get into a stock dividend, but we'll do that soon. You guys ready for the answers?
Yes.
All right, how's this look? All right, I'm going to turn this around so we're getting ready for the next presentation. Okay. Now, let's do another topic to make sure we make good use of our time, and then we'll have a review. So you guys doing good? Any questions, comments? All right, let's get into the stock dividend. So here's what happens in this thing. What we've been dealing with has been all the cash dividend, right? So let's get into a stock dividend. Okay, so we have a stock dividend. So what happens on this thing is, instead of, what they'll do is they'll send out stock, additional stock, to the stockholders. Okay, and of course it'll be proportional, right? So suppose, okay, and then what it is it lowers the market value, or lowers market price. So let's say they send you out shares, so you own one share, you get another share, right? In that case, there'd be twice as many shares out, so the value of the stock should be about half. And I just meant that as an example. Normally, it's not quite that extreme, but then what it is you own twice as many shares, and the market price should be about half in that case, simply because, and the advantage of that is the fact that suppose the stock was really successful, and its price is going up and going up and going up, at some point in time, people can't buy it, especially since you generally buy in round lots, which is your 100 or 1,000. So if the stock is so expensive, people have trouble buying it, okay? Now, if it was half the price, people can just buy it, and it makes it a more manageable transaction. You're not out anything. And second of all, it gives some show of confidence. So what happens is, what it says is, we want to give our shareholders something. We don't have any cash, we'll give them more stock. Now, the advantage to that, of course, is then when the stock rises, you have more stock that rises. But, yeah,
Is this called a split?
a split is a little different. So, but it's kind of basically the same. So here's the stock dividend. Let me kind of wind this up, we'll get to the split. Okay, and now the effect of this would be the same as a split, I might add. Okay, and sometimes it's hard to tell whether it's a stock dividend or a stock split. But if they gave you one share for every share that you had, that would be the effect of a stock split. But it's a stock dividend because they're not calling it in, they're just giving it to you, okay? All right, so if the dividend is a small stock dividend, if it's equal to or less than 20, if it's less than or equal to 25% of the outstanding shares, okay? And they do that at the market value, okay? It's a large stock dividend. if it's greater than 25%. And they do that at par. Okay? Now, so, and the reason is they do this is because if the stock dividend is 25% of outstanding shares, so what they're gonna do is they're gonna send you 1 share of stock for every 4 that you own, right? Then, the transaction, and we don't have time to do it, we'll show you, will be done at market value. If they send out, as we described here, where it was 1 for 1, then the transactions will be recorded at par. We'll show you how that works Monday. Now, the reason FASB decided to do it this way is that this is probably accurate, okay, in terms of what happens. But if you then issued a large amount on the same basis, it would be too destabilizing. And so for just to make sure that things run smoothly, this is recorded par, even though par is an arbitrary number. You know, just negotiated with the state, okay? But they decided that they stated that you do it this way because it just will be less destabilizing. And we'll show you the transactions for this on Monday. And so I think what I'd like to do now, we've got about 7 minutes left. Let's have a review, and I think that review really helps because one final review, I think it moves into the long-term memory, and I think it makes it more memorable. So let's take a minute to do that, and we'll start here. We'll start dealing with stock dividends. We'll show you the journal entry for that on Monday. Okay? All right.